Well, it's not an accident. It was a very obvious result of Fed policy combined with the moral hazards inherent in government-insured bank accounts. But, we've had government-insured bank accounts for a long time, and it has done damage. It's one of the reasons that the system is so unsound. But the reason that we're going to have so many failures is because the Fed kept interest rates so low for so long. I mean, that's what enabled Silicon Valley Bank, Signature Bank, and just about every other bank to load up on overpriced U.S. Treasuries and mortgages. I was talking to one of the guys at Euro Pacific Asset Management this morning who happened to lock in a 30-year fixed rate mortgage at 2.88%, which is, I think, the lowest one I know about. But imagine how much money the bank that owns that mortgage will lose over the next 30 years. They're collecting 2.88% on the mortgage, and the Fed funds rate is 5%. So it's a tremendous loss. But Silicon Valley Bank, is just a victim of that policy. They were just a weak link in the chain because they had a rush of depositors who wanted their money. And so that caused Silicon Valley Bank to have to sell some of the overpriced treasuries and mortgages that it bought. And in so doing, it lost billions of dollars and blew up its capital. And that, they tried to raise capital in the market, but nobody wanted to buy. And so the bank became insolvent. But it was insolvent for a while. It just didn't recognize that because it didn't have to mark to market its bonds. But that's true with all the other banks. Nobody is marking this stuff to market. Everybody is just, putting it in their hold to maturity bucket, and they don't have to take a haircut. They don't have to mark it to market. And so they can pretend that 60 cents worth of bonds is worth $1. But if they had to stop pretending, then they would all be insolvent. And when you're talking about bank deposits, a bank deposit is your asset as the customer of the bank, but it's a liability from the bank's perspective. It owes you that money. When you give your money to a bank, it becomes the bank's money, and you are now a creditor of that bank. And what they owe you is what you deposited. But if they take the money that you loaned them and they blow it on overpriced mortgage-backed securities, then they can't pay you back. Now, of course, what happens now is the U.S. government steps in and says, we'll pay you back. Well, the U.S. government doesn't have any money. Where does the U.S. government get the money? Well, from the Fed. The Fed just prints the money. That's where the FDIC gets its money, which is why everybody is going to lose. These politicians are saying that the banking system is sound. Don't worry about your money. You better worry even more about your money, because the only way the government can make sure your bank doesn't fail is by destroying the value of the money that you have on deposit. It's inflation that is going to wipe out the value of everybody's bank account. Yeah, and first of all, nobody wants to refer to it as a financial crisis. Everybody is talking about a banking crisis. Why don't they just call it what it is, a financial crisis? Because they don't want to evoke any memories of the '08 crisis. They don't want to invite comparison to that crisis. So they're trying to label it something different. No, this is a financial crisis. The 2008 financial crisis was also a banking crisis. Unless people forget, it was the banks that were failing. Yes, they were failing because of bad mortgages, but that was the debt that was failing. And so that's what's happening now. Banks are failing because of bad debt, right? They made loans and they're not good anymore. And so this is a financial crisis. This is the cusp of the crisis. It's going to get much, much worse. If you're going to try to dismiss this as well, it's just a couple of banks, it's just a Silicon Valley Bank or Signature Bank or the other one that failed. That's like, when the subprime blow up first happened, nobody wanted to admit that it was a mortgage crisis. They just said, oh, it's just contained to these handful of subprime mortgages. Don't worry about it, right? Nothing to see here. It's no big deal. It'll just blow right over, right? That was the initial reaction in the mainstream media, at the Federal Reserve. It was nothing to worry about. That's exactly what they're saying now, right? This is nothing. It's no big deal, right? It is a big deal. It's not nothing. And I've been warning about it, just like I was warning about the subprime problems years before they blew up. I was warning about this precise problem at banks years ago. This is not, something that just came out of left field. This is not some kind of black swan that we couldn't have anticipated. This is your garden variety white swan. They're all over the place. This is what swans look like. If you keep interest rates at zero for 10 years, this is what you get. It's not a surprise. Those banks are insolvent too. It's just that they're too big to fail, so we won't let them. But that just means we have to print a lot of money to prevent them from failing. But look, people aren't running on those banks right now. I mean, perversely, what the U.S. government did by fully insuring and bailing out all the depositors of Signature Bank and Silicon Valley Bank, but then coming out and saying, hey, we bailed out all the depositors of these banks because they were big and we were worried about the ramifications for the economy of allowing the customers to lose money. But that doesn't mean that all accounts are insured, unlimited amounts at any bank. We basically created a run on small banks because anybody with a large deposit at a small bank would be an idiot to leave the money there, right? Because why? You might as well pull it out and put it into one of these large, too big to fail banks, because then at least you're not going to lose money if it fails, because they won't let it. But if you leave your money at one of these small banks and it fails, you may be out of luck, right? Because the government may not deem that bank to be important enough to insure everybody's account. So why would you want to be there? For what reason? What is your upside? It's like you're getting a lot of interest to leave your money at a small bank. No, just pull it out. And so now the government is going to create a run on these small banks. And that's going to create a huge problem. Well, look, the Fed was more concerned about saving face. I mean, they had talked about raising rates, and so they wanted to fulfill that commitment because they didn't want to admit that they made a mistake when they talked about raising rates. So they raised them. But I think from their PR perspective, they're going to regret that hike because the next move might be a cut, in which case they look pretty foolish having hiked. It may have been better had they just stayed flat. But they did telegraph now that, it could kind of go either direction next time. So they're no longer kind of locked into we're going to hike. But it doesn't even matter whether they hiked 50 or 25. It's not enough. It's not going to put out the inflation fire because the rates are still below the rate of inflation. So a negative interest rate is fueling the inflation fire. It's not putting it out. And paradoxically, the rate hikes themselves, even though they're not high enough to stop the inflation, they are high enough to make it worse. Because what happens is interest rates are prices. It's the price of money. The price of money is going up. That factors into the CPI. It doesn't factor into the CPI as interest, but it factors into it in prices of everything else. Because if I'm a business, I have various costs. I have labor costs, I have raw material costs, I have rent, I have other things that I have to pay, but I also have interest that I have to pay. And if my interest rates go up, that's just higher costs. What do businesses do with their costs? They pass them on to their customers, and higher interest rates are no different than higher wages or higher raw material costs. So it's going to be passed on. Housing is directly impacted by interest rates, not the price of the house, but the cost of owning it, the cost of buying it. The higher the rate, the more expensive home ownership becomes. That also pushes up rents. As mortgage interest rates are rising, making it harder for people to afford to buy, that makes it easier for landlords to jack up the rent because you don't have the alternative of buying. So everything the Fed is doing is actually pushing up consumer prices. So it's not going to work. The rate hikes are going to backfire. Not that they shouldn't be hiking rates. They actually need to hike them even more because what they have to do is change consumer behavior. They have to change spending and consumption. People need to spend less and save more, but that's not what they're doing. They're saving less and spending more. The savings rate is at a record low. Consumer credit card debt's at a record high. So the Fed is not accomplishing anything. And more significantly, the government continues to spend more money. The deficits are going up. And part of that is being fueled by the higher interest rates. The more the Fed hikes rates, the bigger the deficits get because the government has to pay higher interest. Where does the government get that money? ultimately from the Fed. The Fed prints it. So because the Fed fights inflation by raising rates, it has to create more inflation to monetize larger deficits. That's one of the reasons we've already returned to quantitative easing. Quantitative tightening is a thing of the past. We're back to quantitative easing, so inflation is going to take off.